going to go ahead and get started here. So I am not Scott Clemons. I would hope maybe to aspire to be him, but I'm not. I'm Del Walker with PCAF Texas. And welcome to our 4th annual Gulf Coast Regional Family Forum. I see new faces, I see old faces, I see a lot of great faces. So welcome again to join us for this year. I don't know what you call me, master of ceremonies, moderator. I'm the one that kind of talks the least and keeps things moving. And so all I find is best to start with some kind of some protocols. Everybody in this room is bright, and so trying to define the fairway a little bit. So everybody should have a paper copy of the agenda. So if that's important to you, you should have it right in front of you from that standpoint. Once we get going, we delayed start a little bit because the joys of Houston traffic and weather wanted to get folks in the room, and it seemed to work. We got a very full room at this point in time. You're going to see people occasionally in the back of the room while people are up here at the podium or speaking, and they're going to be raising colors and hands. Ignore them. It's part of our signal to advise people of when time is. It means nothing to you in the audience. It means everything to the folks up here from that standpoint. Lunch. Some of you have been here in the past, and we've done lunch in a separate room. This year, we're going to do lunch in here. We're going to have the buffet set up out in the foyer right out there. So what you'll do when we're at, we'll get into details. Basically, we will go out there, get in the buffet line, bring our food back in here, dine in here. The hotel will help us clear the service. We're not having a speaker at lunch this year, and so we won't have to deal with any conflicts on that. So from that standpoint, so you're not going to have to traipse through the hotel to eat today. Questions for cards. I think there should be on each table some notepads for questions. So instead of doing the pass the mic and have people run all over the room, what we're going to do is when we get to the point in the panels and the discussions and say we're at questions point, we're going to ask you to put your questions in writing, and then we'll forward them, and then we'll get them up to the facilitators from that standpoint. So from that, let's see, a couple other things here. All right. Feedback questionnaires. Every table has feedback questionnaires. And I'm going to stress this. This is really important to us because you're going to see some changes at this year's event, and it all came out of the feedback process from last year. We're now one-day events instead of two. We started later in the morning versus dealing with the face school traffic and the loop traffic. They also said we want more time to talk and network with people. So we made lunch a dining and networking fellowship experience only, as well as the break time. So we're trying to listen to you and accommodate that in addition to our cocktail reception that we have at the end of the day. We have some set breaks, but I may go freelance if I get the look out in the audience that people need to step out. You know, we don't need to have any accidents here at this point in time. So if I break ranks for me, trust me on that and kind of take care of business and get back quickly. For those in the room that CPE matters, which is a small but important group of us, CPAs, make sure you fill out your paperwork, and we as PCAF Texas will accommodate you for your CPE requirements. So a couple of opening items that are not logistical. This is, like I said, 4th annual. This is something my partner Bill Rankin and I have done for 4 years now. When we started this, wasn't really sure we'd see 4 years. We took some risks. We've done this together. We like to say we ham and egg it, so to speak. I'm not sure who's the ham and who's the egg, but this is clearly a teamwork effort, and couldn't do this without you, Bill. I'm supposed to say something nice about you, but I'm not sure I can do that, but you know that I greatly appreciate what you do, and couldn't happen without Bill. In addition, we've had some other folks that have been with us from the beginning. Chris Graff with Mercer Advisors, Canaley Trust. Chris, where are you? Chris has been an invaluable partner from the get-go. Thank you for you and your organization's ongoing commitment. A new partner that's joined us that's been another invaluable partner along with all of them has been the folks from Brown Brothers Herriman in New York. Harry Mallory, Travis Dunn, Mr. Clemons, come and join us again. Thank you very much for your involvement and contribution. Somewhere there's a slide that has all of the organizer firms on it. I thought it would be sitting up there. But if we could get that up, there we go. We have a great number of organizer firms. They're all invaluable in their contribution, and can't say enough and thank you to each of you in terms of your role in making this happen. It clearly takes a village from that standpoint. So just a couple of comments. So this year's theme is shifting paradigms in Houston. And so some of us need some help with definitions. So I went to Webster's, and what does shifting mean? All right, shifting is to go through a change or a change in emphasis, judgment, or attitude. All right, so that's what the shifting part means. But what's a paradigm? And I wasn't educated in Texas, so this is a reach for me. So that's why Webster's is important. An outstandingly clear or typical example or archetype. So we are dealing with shifting examples and archetypes. So let's talk a little bit. So at 4 years, when this started, what are some things that have changed? And it's fascinating kind of going through this, looking back the last 4 years. As someone who will be 56 this summer, there's a lot happened in the last 4 years in the world, the country, Texas, and Houston. So the Dow 4 years ago was at 17,000. Today, it's at 26. Fed funds rate was 6 basis points. Today, it's 240, both incredibly low. West Texas Intermediate crude, something that we all care about and pay attention to, it was at 37. Today, it's at 57. Corporate tax rate is 35%. Today, it's 21. I have to tell you, looking at change, I'm not done here, you know. Speaker of the House was Paul Ryan. Today, he's unemployed. Nancy Pelosi, Speaker of the House. President of the United States was Barack Obama. Today, it's Donald Trump. And just think about what's gone on the last 4 years. The phrase flyover state, which I had never heard before, to me, that was talking about the I-10 Beltway interchange construction, the flyover state. It don't mean that anymore, does it, from that standpoint? You know, and having an opinion about the wall doesn't have a dang thing to do with Pink Floyd from that standpoint. And I will tell you, the Pink Floyd album that probably applies most to today is Animals. If you haven't ever listened, you ought to check it out. But, I mean, from someone who grew up as a Pink Floyd fan, it's not applicable anymore, and you have to be careful how you talk about it. And you look at our great city, what we've overcome in the last 4 years. We had the tax day floods. Then we had the Memorial Day floods. And then we had Harvey. And all three of them were haymakers, and we've come out of it. In the last 4 years. You know, the Astros brought us a World Series after how many years? The Beard brought us an MVP. Mr. McNair passed away. NRG hosted a Final Four and the Super Bowl, all in the last 4 years. And then, you know, this ties in today. You know, in this process, our city came together and put forward what we thought was an incredibly compelling effort to get Amazon here. At the end of the day, we fell short. And we're going to learn about that, probably talk about that later today somewhat. But being on that short list doesn't seem to mean anything anymore either. Look what's going on in New York. So maybe it wasn't as disastrous as we thought from that standpoint. So in hindsight, everything has been fascinating. So I would say all these are kind of wonderful, vibrant examples of the shifting paradigms that impact and define our great city that's Houston and our home. And I just say with that, you know, our last 4 years obviously been anything but dull, at least for me. I think we're going to find the next 4 years and beyond, I think even more interesting. I sense a very magical journey lies in front of us. And so with that, let's stop talking about the past, shift our view to the horizon, and get our day started. So with that, let me introduce Mr. Scott Clemons from Brown Brothers Herriman. For those that were with us last year, he joined us, did a phenomenal job. If you haven't met him, you ought to take a chance to get him. But he's 29 years with Brown Brothers? So he joined them back in 1990. He is their chief investment strategist. You may have seen him quoted in the Wall Street Journal, Barron's, seen him on CNBC or Bloomberg News. He's a CFA charter holder and a member of the New York Society of Security Analysts and a CFA Institute. And last but not least, definitely a smarter guy than me, he graduated magna cum laude from Princeton University with an AB in classics. And so with that, Scott, I turn it over to you to kind of open our day for us. Right. Thank you.
Thanks, Del. Thank you all for coming. I think this is on, right? Okay, great. And my slide should be headed this way soon. How many of you know who Brown Brothers Herriman is? A few? Okay, more than a few. Oh, that's great. Warms my heart to hear that. We have just come through a rather important year. We spent all of 2018 celebrating our bicentennial. The firm was founded in 1818 as a private partnership. That's no big deal. In 1818, every firm on Wall Street was a private partnership. There was no other form of corporate ownership structure. But over the subsequent 200 years, one by one, every single firm limited that liability in some way, usually by going public, but sometimes by moving to an LLC or an LLP type structure, to where now, as we stand here in 2019, there's only one firm left on Wall Street that retains that original general partnership structure, and that's Brown Brothers. And that has some really interesting implications, one of which is that it's wholly owned by 31 general partners. There's no outside capital. Those 31 men and women carry joint and several unlimited liability for the activities of the firm. It's Dickensian in a way. The lawyers in the room always gasp when I say that. We like it. We're proud of it. We're stubbornly proud of it. Maybe proudly stubborn, depending on the day, because it aligns our interest as owner-operators with those of our clients. And so the private business community is very important for us. It resonates with us. It resonates with what we do. And a lot of the clients that we work with are themselves private business owner-operators. And again, I think there's just a resonance with the way we look at the world and the way they look at the world. We're in three primary businesses. The one that I'm responsible for is private banking. We work with families and business owners to help them manage that wealth, whatever form it takes, whether it takes the form of a business, whether it takes the form of a financial portfolio, or transitioning from one to the other. So a lot of the way I look at the world, either economically or from a policy standpoint or in terms of monetary policy or what's going on globally, is through the lens of that owner-operator. And so that's a context for some of the comments that I'll make over the course of the next 25 minutes or so. And we'll leave plenty of time at the end for questions, so do scribble them down and they'll get passed up to me. I'm around all day and into cocktails tonight, so as Del said, buttonhole me if you don't get your question in over the course of the morning. I'll put my email address up at the end if you'd like a copy of these slides. I'm happy to send them to you, happy to have you share them with colleagues or friends. Nothing here that's terribly proprietary, just sort of the way that we look at the world. When you work for a firm that's 200 years old, you gain a certain appreciation for history and the lessons that history has to teach. And that's not to say things haven't changed. I mean, listen to Dell's recitation of what's changed in the past 4 years. Think about what's changed at our firm in the past 200 years. Regulatory structures, unrecognizable. When the firm was founded in 1818, there was no central bank. There was no central bank for the first 100 years of our existence. That's a relatively recent phenomenon. The one constant, though, throughout all of that is human nature. And all a market is the interaction of human nature. Hope, fear, desire, greed, lust, and sometimes. Same thing with economies. That's the common thread, and that's why history provides such a good guide, not only to what's going on now, but what's likely to go on going forward. So let me start by looking at very recent history, and that's the resurge of volatility in the fourth quarter of last year, culminating really on Christmas Eve, ironically, was the date on which volatility really spiked to historically high levels. There are a lot of ways to measure volatility. The one that I'm fondest of is this sort of mouthful, the Chicago Board of Exchange Volatility Index, the VIX. You've all heard of it, you've read about it. It's the colloquially called fear index. The vertical axis, those aren't really units of anything. This is just the aggregate of all of the implied volatility in every single equity option that trades on the Chicago Board of Exchange. And you can see that the spike that we had in Christmas Eve of last year, that last little spike there, it's unusual, but it's by no means unprecedented. It's happened a couple times, half a dozen times or so in the past 10 or 15 years, usually with a reason, and usually the reason's rather identifiable. Obviously the financial crisis, the big kahuna. Remember the flash crash in May of 2010, that sort of weird technical glitch in markets sent volatility spiking. When the U.S. debt rating was downgraded, fears about Chinese economic growth a few years ago, and then last year, a couple of fears about U.S. growth. I'm going to admit something to you, though, right now that you'll never hear an economist say. This chart is intellectually dishonest. So to scratch out whatever notes you just took on this chart, by the way. The reason it's intellectually dishonest is because the reasons for this volatility are always obvious in the rearview mirror. There is no volatility spike on this chart labeled U.S.-China trade disputes, because there was none. There is no spike on this chart labeled Brexit, because there was none. Although, obviously, those are two big, pretty important global events. It's always easy in retrospect to define why something happened. And God bless the journalism industry. They have to do this every day of the week. Every day of the week, they have to fill out the headline, the market went down today because ... and there's always a reason. Here's my proof statement for that. Why did the market go down in the fourth quarter of last year? It's a long list of reasons for that. Fears about higher interest rates, fears about the impact of Chinese tariffs and the trade disputes that were escalating, fears that the Fed was tightening monetary policy too quickly, fears of a government shutdown. I mean, you could go on and on and on and on. There's a long list. It's a target-rich environment. But which of those things did we not know in September when the market was making all-time highs? They were all there. In reality, what's happening says more about the internal state of the market itself than it does about external circumstances. Consider the following analogy. If we were to take a break in the proceedings and build a pile of sand on one of these tables, one grain at a time, eventually you would get a very predictable shape that would emerge. But at some point, one additional grain of sand would cause that whole pile to shift, and we would stop and we would say, why did that happen? And as tempting as it would be to blame that last grain of sand, in reality, it was no different from all the grains that came before. The reason the pile shifted is that the internal state of the pile itself became critical and therefore prone to overreact to external stimulus, even if no different from that came before. So all of this news flow that was known in August and September and October are just grains of sand falling on a rather complex system called a financial market or a pile of sand that eventually shifted because of that critical state. Now, there's a bad news and a good news implication of that. The bad news is it is impossible to accurately predict the criticality of a system as complex as a pile of sand or a financial market. There's no probe you can stick in that pile and say, we're only 10 grains of sand away from something happening. And that means you cannot predict asset prices today or tomorrow or next week or next month. That's the criticality at work. Over longer periods of time, it becomes more fundamental, but over shorter periods of time, the state of the pile itself is an unpredictable state. That's the bad news. The good news is once the piles shift, once that system is de-stressed, it's in a much more resilient state, a much more robust state. For a while, right? The criticality starts building again, the grains of sand keep falling, but for a while, the pile itself is much less prone to overreact to external stimulus. I think this helps to explain not only what we saw in the fourth quarter of last year, the pile shifting, if you will, but a much more resilient and robust state that we've seen so far in the first quarter of this year. Having said that, you'll read a lot of market commentators, and you've seen them already this week, that say the end is near, we're on the verge of recession, we're already in recession, and the market's simply presaging that the volatility of the fourth quarter was an early warning sign, if you will, flashing red light that something bad is about to happen or indeed is already happening. Let's test that hypothesis. What I've done here on this page, and again, I'll put my email up at the end, and I'm happy to send all this data to you, so you don't feel need to scribble it down. I've looked on the left-hand side. Those dates are all dates on which this measure of volatility, the VIX index, spiked above 35. And there's nothing magic about that number. I've just picked that number as a litmus that defines a pretty rare event, but not one that's unprecedented. It's happened 12 times in the past 30 years, roughly 30 years, the most recent of which Christmas Eve of 2018. I then asked myself the following naive question: what happened next? That simple. What happened to the markets in the subsequent 1 month, 3 months, 6 months, and 1 year? Well, you can see at the bottom, 1 month out, it's a coin toss. Half of the times the market was higher a month later, half of the times it was lower, kind of a rounding error around 0 on average. But the further out you get, the more likely it is that the market has recovered, and actually recovered rather robustly from that volatility spike. If you look all the way out at the 1 year number, 9 out of 11 historical times the market's higher, usually by double digits. There are 2 exceptions to that, and these are 2 exceptions that I think help to prove out this rule. 2 periods in which the market was actually substantially lower a year later. 2 exceptions in which that market volatility actually did indicate something bad to come. And if we unpack what those times were, I think it helps to give us some ideas to what to look at now, what to look at going forward. September 17th of 2001 was the day the financial markets reopened following the attacks of 9/11, a truly unprecedented black swan volatility-inducing event. That was a Monday, and on that Monday, markets collapsed, volatility spiked. And although it wasn't entirely evident at the time, the economy was already headed into recession, not because of 9/11, not because of the volatility spikes, but the economy was already rolling over. That had a negative impact on corporate earnings, and by a year later, that had a very negative impact on financial market activity as well, as you can see from the performance. Similarly, in 2008, a little closer to home, on September 15th of 2008, Lehman Brothers declared bankruptcy. On September 16th of 2008, the federal government bailed out AIG. On September 17th of 2008, the market concluded that this time was genuinely different. The market began to collapse, volatility spiked, and of course that was the onset of the financial crisis and the global recession. And again, that linkage between real economic activity feeding into corporate economic activity, feeding into financial activity held. So in the 2 out of 11 examples where there genuinely was a downturn, the culprit wasn't volatility, it was fundamentals. And I think that's the important takeaway from this, that otherwise what we're seeing is a normal de-stressing of the market, fourth quarter of last year, followed by a robust and more resilient rebound. So the $64 million, billion, trillion question is, which of those two experiences are we likely to go through over the course of 2019? The answer to that lies in an insight into what's going on in the underlying fundamental economy. I think I shared this paradigm with you last year, and I'm going to do it again because I think it continues to work. What really drives this economy, and indeed any developed economy, is personal consumption. The spending decisions that all of us, plus our 320 million fellow Americans, make on a daily basis adds up to close to 70% of GDP. And that is not to be dismissive of everything else, but business investment, government spending, trade, in aggregate combined, adds up to 30%. This is the 800-pound gorilla. You're the big kahuna. As goes the consumer, so goes the economy. What is it that drives personal consumption? That's a psychological question. It's not an economic question. And the answer is a wealth effect and an income effect. When we spend money, and it does not matter how much, we do so out of a sense of financial well-being. Am I rich enough to afford this? Do I make enough money to afford this? Again, 99% of the time, that's subconscious. But that's what's driving the ability, and more importantly, the willingness to spend money. The psychology is important. In turn, the primary store of wealth in this country is not financial. It's real. It's housing. 95% of American households, most valuable asset they own is the roof over their head. Housing market is a very important store of wealth. Maybe more obviously, the primary driver of income is the labor market. Whether or not you have a job, the security you feel about that job, the likelihood of getting a raise in that job, all of that drives the income effect. Again, both in a real way and in a psychological way. That feeds through into personal consumption. That's 70% of the GDP equation. There is something different this time around, something that helps to explain why this economic cycle feels different. May even help to explain why this economic cycle has been as long as it has been. For the first time in decades or even generations, American households are deleveraging their balance sheets. They're paying down debts, and they've increased their savings rate. This is a welcome development, by the way. This restoration of the financial health of American household balance sheets is long overdue, and it means the next economic cycle does not have to be as protracted and prolonged and painful as the last one. There will be more shock absorbers in place. That's great. In the short run, however, that dollar you use to pay down a credit card is a dollar that doesn't get spent, doesn't flow through GDP. That alone, that dynamic alone, and I'll show you a graph that puts some numbers around this, that alone helps to explain why this economic cycle has been as modest as it has been. It's not tax policy, it's not interest rates, it's not the Fed, it's not the Trump administration, it's not the Obama administration. We're simply paying back bills incurred in previous economic cycles. It's just that simple. This paradigm helps to give us some insight into what we should pay attention to. Housing market's important, labor market's important, and the strength of these deleveraging trends is important as well. Let's look at those three things briefly, because I think those are sort of my proverbial canaries in the coal mine to give me some insight not only into what's going on right now, but what's likely to go on going forward. The labor market's in great shape, almost no matter how you look at it. Blue bars on this page are the net monthly job gains. This is the report we get from the Bureau of Labor Statistics at the beginning of each month, first Friday of each month. I'll do the math for you, I'll add it up. We've added jobs now for 100 consecutive months. That's a record. That's brought the unemployment rate down to 4%. Last time the unemployment rate was this low, Lyndon Baines Johnson was the president of the United States, and the Beatles' Hey Jude was the top of the pop charts. This is 50 years ago. That's been a while. That's how good the labor market is. And it's likely to stay that way. One of my favorite statistics within that Bureau of Labor Statistics report, which is very long, I do not recommend you reading it unless you're having difficulty falling asleep. You can abstract back from the percentages, which can be a little difficult to get your hands around, and look at the sheer numbers. And I love looking at the sheer numbers because they're more tangible. So one of those numbers looks at absolute job openings. What are the jobs on offer? These are not theoretical. These are roles that an employer would fill tomorrow if the appropriate candidate presented herself. As the economy recovers, the number of job openings increases. That's businesses expanding, opening new plants, creating new product lines, whatever it is. You look at that data point right now, it's about 7.5 million job openings. That's as of December, end of December, most recent data. Interestingly, you can also look at the available supply of workers. This is sort of the real number of the unemployment rate, not a percentage, but a real number. There's about 6.5 million available workers. In other words, there's a gap of 1 million souls between the jobs on offer and the people available to fill them. That has never happened. You can see it's happened now for 6 or 7 months in a row and seems to even be widening. That is a remarkable statement to me about the tightness of the labor market. That has two implications, one of which is the health of the labor market is likely to continue improving simply as a reflection of that gap. When there are 1 million more jobs to be filled than there are people to fill them, that says to me that employers are going to find ways to fill those jobs. They're going to move people across the country, they're going to increase offers, they're going to increase benefits, whatever it is, in an attempt to fill that gap. The second thing this tells me is something about wages, because this is just a supply and demand graph. And what do we know from Econ 101 about any commodity, oil, pork bellies, orange juice, labor? When the supply of a commodity falls and the demand for that commodity rises, the price goes where? Up. It's taken a while for that to happen, but it's begun to happen. It's begun to actually accelerate. This is a graph of average hourly earnings, which you can see never declined, even during the worst part of the financial crisis, never really declined, but we're growing at a pretty modest rate of 1, maybe 1.5%. That acceleration has begun as the labor market has tightened. Most recent data on this has wages growing at 3.2%. This is only the wage component of employment costs. It does not take into account non-wage factors, healthcare benefits being the biggest part of that, which of course are growing faster than 3.2%. I'm focused on wages because what I'm really focused on is what kind of money do people have in their pockets and are they willing to spend it? This is all about personal consumption and GDP. Here too, as is the case with most economic data, there's good news and bad news. The good news is when you combine all this together, this is more people with more jobs, with more money in their pocket, and when that income effect drives personal consumption and GDP, that linkage is pretty robust and pretty important, and it's in good health. That's the good news. The bad news, maybe the potential bad news is at some point, not yet, but at some point, that becomes inflationary. More money in more people's pockets means the greater ability to spend money on everything. Orange juice, pork bellies, flat screen TVs, new cars, et cetera, et cetera, et cetera. That degree of demand-driven inflation is what makes Federal Reserve governors very nervous about incipient inflation. Not today's risk, not today's story, but something certainly to keep an eye on. Talked about the housing market, primary driver of the wealth effect. Here too, I think housing remains a tailwind for economic activity, although I will readily admit that that tailwind has begun to wane for two reasons. One, mortgage rates are higher. Not much higher, but they're a little higher, and at the margin, that diminishes the affordability of housing. Two, one of the results of the tax package of 2018 constrains the ability of mortgage holders to deduct mortgage interest. Not that big of a deal in most parts of the country. Where I come from in the northeastern United States, that's a pretty big deal. And again, at the margin, economically, what that does is it diminishes a little bit the affordability of housing. And I think we may be beginning to see that. So the blue line here is the median price of a home. The red line is just the year-over-year rate of change. That's just the first derivative of the blue line. And you can see that housing prices for most of the past 6-7 years growing around 5% or so, that's weakened. Still growing nationwide, about 3%, but not 5 or 6. And I think what we're seeing here is just a little bit of a cap on the housing market. I don't think we're seeing a turn in the housing market, but I will readily admit that on my list of things to watch and worry about in 2019, this is one of them. This tailwind to the wealth effect, again, both in a real sense and a psychological sense, is something that I want to keep an eye on. There's no signs of regional housing weakness. You can back away from the national numbers and look at this on a regional basis. This is a study that looks at the 20 major metropolitan areas. Those can be very hard to read. Sorry about that. This is the year-over-year rate of growth for housing prices in those regions. And the takeaway is just that every region is showing housing price strength. Some better than others. Some, that's Las Vegas there on the very right-hand side, still recovering from the housing crisis of 10 years ago. Housing prices in Las Vegas are still about 40% below their peaks of 2005. So you're still seeing a recovery there. On the lower end of this scale, you're still seeing housing prices growing at 2 or 3 or 4% in major metropolitan areas. In an effort to get even more granular, I went back and looked at just the last 3 months. Is there signs of incipient weakness, new weakness? And the answer is, I think no. 2 markets in which housing prices have shifted a little tiny bit into reverse, and I'll read these for you because they're hard. That's San Francisco, that little dip right there. And if you know this from reading newspapers, San Francisco housing prices are through the roof because of technology and the growth in technology in Silicon Valley and demand for housing. It's become the most unaffordable housing market. Maybe a little bit of relief taking place there. This other dip over the past 3 months is Seattle. And I actually think that's an Amazon effect. As Amazon went through the long process of looking for new headquarters and then gave them to Virginia and New York and then took New York back, that has to have an impact on housing prices in Seattle because the marginal job growth from a very large employer like Amazon is not taking place in Seattle. It's taking place somewhere else. Not in New York City anymore, but don't get me on that soapbox. Bad decision on behalf of New York. So I think that those are still a tailwind, but it's something that we'll watch. I referred to this deleveraging effect, and that may sound like a contrarian statement because you've read in the press, and it's absolutely accurate, that household debt is at an all-time high level. So how can I talk about deleveraging? In the same way that you would never gauge the quality of a corporate balance sheet only by looking at debt. It's always debt relative to something. Same thing with housing, same thing with households. It's debt relative to something. And no matter what you look at, debt relative to income, which I show here, debt relative to assets, you see that peak and a decline, a deleveraging, a relative deleveraging. So really what's going on here is, yes, household debt's at an all-time high level. Household income is at an all-time higher level. Household assets at an all-time higher level. When you combine those two things together and look at the indebtedness of household balance sheets, this is a very long-term graph. It goes back about 70 years. You can see with some exceptions, there have been some periods in which this growth in debt has kind of flattened out a little bit, but nothing like what we've seen over the past 10 years. Debt to income peaked about 134% just prior to the onset of the global recession, back down now to a little south of 100%. The difference between that peak and where we are now is meaningful. If you translate that into dollar terms, it's about $5.5 trillion. That's what we in the economics profession refer to as a really big number. It's about a third of GDP. Think of that, a third of GDP that has gone unspent. It's been used to deleverage. Again, no wonder why this economic cycle has been as modest and as flat as it has been. We've grown at roughly 2.5% over the past 10 years, and this is a big part of why. Nothing else that you've read. It's not policy, it's not interest rates, it's not taxes, it's just this. And this is a pretty dramatic trend. So back to this roadmap, I think this is in reasonably good balance. There's enough of a tailwind from the housing market, a little bit more of a tailwind from the labor market to create enough wealth and income to drive personal consumption and therefore modest GDP growth, while at the same time allowing for this deleveraging trend to take place. And I don't see anything there changing. And I get asked the question all the time, how long can this go on? As of the summer of this year, this economic cycle will be 10 years old. That'll be a record. Post-war, pre-war, a record. It's a record for this country. There is no expiration date on an economic cycle. Australia is currently in the 27th year of an economic cycle. I know it's a different country, it's more commodity-driven, it's smaller. I get all of that. But it's just a testament to the fact that a developed economy, particularly one like the United States, focused on information services and services as opposed to earlier economies that were manufacturing-driven or even agriculturally driven. The old rules of business cycles no longer apply with the same precision or with the same frequency. Here's a paradigm shift, though, that's worth keeping an eye on because I think it does pose a risk this year. There's no question in 2019 that economic activity will be more moderate. And prepare yourself for the headlines that say, oh my God, economic activity in the United States is slowing down. I'm going to go out on a limb. You'll see those headlines on Friday morning of this week. How's that for a forecast? Because tomorrow we're going to get the preliminary GDP report for the fourth quarter. And it's going to already start showing signs of those slowdowns. All that's happening is that the benefits of the 2018 tax cuts are now embedded in the year-over-year numbers. That's it. It's just math. So the economy was growing at sort of 2.5%. The tax cuts came in. A direct impact on the income effect, right? We kept more of our money in aggregate. Maybe not everybody in this room, but in aggregate. That drove personal consumption and therefore GDP that was about 1 percentage point higher. We had about 3.5% GDP growth last year. In 2019, that's just going to revert back to the kind of 2.5% pace that we've been on for about a decade now. So yeah, economic activity is slowing down. Mathematically, that's an accurate observation. But without the context of that's simply because the tax cuts are fully annualized, it can be very misleading. So it's a headline risk. And I think we may see the same risk when it comes to corporate earnings, and for the same reason. Corporate earnings last year, this is the S&P 500, so large public companies. The blue bars here, the last 3 quarters, that's the first, second, and third quarter of 2018. Corporate earnings grew 25%. Unbelievable for the 10th year of an economic cycle. Again, there was a tailwind of corporate tax cuts in there, and as those corporate tax cuts are annualized, corporate earnings are not going to grow at 25% this year, which will give rise to the headlines about how corporate activity is slowing down and earnings are slowing down. Yes, but the context of the tax cuts and the benefit of them last year is really, really important. The gray bars here are the forecast, the expectations, consensus expectations for 2019. It's more moderate, sort of mid-single digits, 5, 6, 7% earnings growth. Not a bad pace of growth for the 10th year of an economic cycle. If there's a silver lining in the otherwise dark cloud of the market correction in the fourth quarter of last year, it's this. It's brought valuations of financial markets back down to much more reasonable levels. And the math is pretty simple. This is just the PE, the price to earnings ratio. What happened in 2018? The P part went down, the E part went up. Prices came down, earnings went up. And the ratio of one to the other fell rather dramatically. This is a good thing. At the beginning of last year, I was worried about the overvaluation in the markets. When this conference took place last year, the PE ratio in the markets was up there at that little peak. We were at about 23 times earnings. That's by no means a record, but that's pretty lofty. What's happened over the course of the year, again, because of the fall in P and the rise in E, the PE multiples back down to about 17.5 times earnings. Not cheap. I'm not making the argument that the market's inexpensive. I'm simply observing that the market is back down to much more reasonable levels of valuation. And that's an important mitigant of a risk that I think was on the table very much last year. So a couple of conclusions before I look at what the risks are for 2019. I think the underlying fundamentals are fine. And when I look back at history, and history is a guide on what spikes in volatility mean, I don't think we're in one of those circumstances in which the economy is slipping into recession or on the verge of slipping into recession, although I readily acknowledge that economic activity in 2019 is almost certain to be more modest than it was in 2018. And the culprit or the reason there is the tax cuts that we've already looked at. Same thing with corporate earnings, but in an environment in which equity valuations are much more normal, much more reasonable, I think that is another example maybe of that complex system shifting and becoming a much more resilient and a much more robust state. Couple of risks, though, in 2019, a couple of things to keep our eye on. The first of which is a disconnect between the expectations for inflation and what I see as the real underlying inflationary pressure. There are a number of ways to look at the way in which inflationary expectations have evolved. There are surveys, certainly. I prefer to look at the markets themselves. And you can look at the so-called break-even spread as an indication of what the market's aggregate expectation for inflation is. Little inside baseball, but what you're looking at here is the difference between the yield on the 10-year government bond and the inflation-protected equivalent 10-year government bond. The only difference between those two securities is who bears the risk of inflation, the Treasury Department or you, the bondholder. And so the difference between those two yields is the market's aggregate expectation of what inflation will be over the life of the bond, the next 10 years in this case. So when I ran this data a week or so ago, that break-even was 1.9%. In other words, that's the market saying that inflation will average 1.9% over the next 10 years. This seems incompatible to me in an environment in which the unemployment rate is 4%, wages are growing at 3.2%, and there's increasing price pressure coming from those higher wages. Something's got to give. What I think gives is that the bond market begins to appreciate that there's more risk of inflation than they currently do. I'm not talking about high inflation. I'm just talking about more inflation than what seems to be a rather sanguine outlook at present. So that's a disconnect. We'll see how that plays out. A second disconnect, a related disconnect, is maybe the broader disconnect simply between the current state of economic activity, even if it is slowing down, and what the market expects the Federal Reserve to do in terms of monetary policy. This is obviously related to the inflationary question as well. I'll show you one last picture on the economy because I think this is probably the closest thing I've ever come across to a crystal ball. Red line here is the aptly named Index of Leading Economic Indicators. It's an aggregate of a bunch of different indices, including short-term interest rates and purchasing manager sentiment and business sentiment. The blue line is just the year-over-year rate of change. The green bars are periods of recession. And what you see here is prior to the onset of recession, in every case, this Index of Leading Economic Indicators not only turns down, it does so rather unambiguously. There's no debate that it's in decline because the blue lines collapse. The rate of decline is rather quick. Where we stand now, the last data point on the red line is at an all-time high. The year-over-year growth in the Index of Leading Economic Indicators has moderated somewhat. I think we're beginning to see that more modest economic activity, but still growing at about 4% year over year. So there are no near-term signs of fundamental economic stress. I think the utility of this analysis is a couple of quarters at most. Things change, but a couple of quarters from now gets us well into the third quarter of this year. I would say the likelihood of a recession in 2019 is remote. There's no fundamental signs of stress. And yet, the market seems to think that the Fed is done raising interest rates. And again, that's a subjective statement, but you can objectively measure it. You can look at the Fed funds futures market and apply a probability analysis to gain some insight into what the Fed's likely to do. So the dates at the bottom of this page are not random. They look random. These are the dates of Fed meetings. These are the dates on which the Fed could move interest rates. The green bars here are the probability of a rate increase on any of those meeting days. And this goes all the way out. I think the last date there is January of 2020, so the next 8 Fed meetings. At no point does this probability rise above 3%. That's astonishing. That's practically 0% probability. The market is saying that the Fed raises interest rates this year, in spite of a healthy labor market, in spite of decent economic growth, in spite of the fact, as Dell referred in his opening comments, that interest rates, the Fed funds at 2.4%, are still relatively low. What's even more interesting is you can also ask, well, what's the probability the Fed raises interest rates? Practically 0 for most of the next few meetings, but look what happens later this year and into 2020. These are not majority probabilities. Don't run away with these probabilities. But still, a rising probability that by this time next year, economic activity is so weak, the Fed's actually cutting interest rates. That seems incompatible to me with a labor market in good shape and the tailwind of housing and the kind of fundamental economic supports that are still very much in place. We will see. My expectation is that by the second half of this year, September or so, the Fed is confident enough in the pace of economic activity here at home in the United States that they're able to raise interest rates once or 2 more times. This would bring the Fed funds rate up to about 2.75%. These are not high interest rates, just higher than they are now. Remember, one of the Fed's primary goals is keeping an eye on inflation. And with wages growing at 3% plus, that's something that they've got to keep an eye on. A third risk, and I worked very hard on crafting this language to be nonpartisan. You'll tell me if I succeeded. But political dysfunction could derail any of this fundamental analysis. We live in a world in which both parties have demonstrated a willingness to weaponize the normal functioning of government. That's different. I did not worry about this in the past. In the past, the political gamesmanship of, well, we're going to shut the government down for a few days. Big deal. Washington thinks it's the center of the world. It's not. New York is. Houston is. Slip of the tongue. But there's something different when you can shut governments down for weeks on end. That's different. The economic cost of that is somewhat calculable. The White House's own Council of Economic Advisors estimated the cost of a shutdown at 0.1% of GDP per week. So you can do the math. The government was shut down for 5 weeks. That's roughly 0.5% of GDP. Here's my concern. I don't think the economic impact is linear. I think it's geometric. Things get a little bit worse each week. So what does that look like? Again, these are not forecasts. This is just an example of that. What if the impact isn't 0.1% each week? What if it's just a little tiny bit worse each week? 1% worse. That's not another percentage point, but 1% of 0.1%. Tiny, tiny, tiny numbers. Compounding begins to kick in. What if it's only 2% worse each week? I mean, those lines begin to be a little scary if a future government shutdown lasts longer than only 5 weeks. At the 5-week level, there's not much difference between those lines. I mean, the impact is pretty negligible. But if this were to be a recurring event, and the government shut down how many times in 2018? Anyone? 3 times. 3 times in 2018. Last one was the long one, we remember. 3 times. If this becomes a normal functioning of government, the risk to the economy could be much larger. But wait, as they say on TV, there's more. Remember the debt ceiling? Remember how fun that was? We're going to do that again. The debt ceiling was suspended as part of the 2018 tax package. This is the debt ceiling. So as of in February of 2018, it was just lifted. It was made to go away as part of the deal with Congress to get the tax package through. But as part of that 2018 tax package, the debt ceiling comes back into existence like a zombie arising from a grave on March the 1st of 2019. That's Friday. And it will come back into place at the then prevailing level of debt, which is about $22 trillion. So the red line on this page is outstanding U.S. federal debt. At the risk of being uncharitable, might I observe that the debt ceiling has not proven to be a terribly effective way to control the issuance of debt. All right, those are essentially the same lines. So we'll get a debt ceiling back in place 48 hours from now, and we'll be right up against it. Now, as you remember from previous episodes of this series, the Department of Treasury has ways in which they can continue to fund government through special means without having to issue more debt. Essentially, they borrow money from other parts of government. Those special tricks run out in 6, 7, 8 weeks. Depends on how quickly they have to fund things. That means by late spring, early summer, we could be right back into an environment in which the debt ceiling becomes a political football as well as it has in the past, and in an environment in which the 2020 campaign is already being waged, the risk for mischief is really high. And again, do not take that as a political comment, as a partisan comment, or even as a projection, just as an observation of this different kind of non-fundamental, non-economic risk that may nevertheless affect sentiment. And remember my flow chart, sentiment is a really important part of the way people spend money. A fourth risk, and then I'll leave it off there, is just to acknowledge that we compete in a global economic environment. What happens outside the United States affects us. Even though we are largely domestically driven, personal consumption being a domestic dynamic, foreign demand matters, and foreign demand is slowing down. 2 big snapshots of that. One, China. We can come back to this in the Q&A if you want to. Chinese economic activity is slowed down. Where we are now, just about 6%, is the slowest it's been in sort of forever, if you will, at least recorded modern economic history. It's back down to where it was in the worst days of the financial crisis. You can look at this as a glass half empty, glass half full type analysis. Most people consider this a threat to global economic activity. I'm kind of a glass half full guy when I look at this. I think what we're seeing here with China is a rare and maybe even unique example of an emerging economy actually emerging. Because they never do that. If you go back and look at the composition of an emerging market equity index in 1968, it's the same countries today, 50 years later, which gives rise to the old joke in emerging circles that country XYZ, fill in whatever your favorite emerging market is full of potential and always will be. They never quite make the transition. China's making the transition. And again, we can go into this, but the real reason for it is demographics. China is a very large but a very old, aging population, except China does not have the financial wealth with which to create their own equivalents of Social Security, Medicare, Medicaid, the Affordable Care Act. They don't have any of the social safety nets that we have. The social safety net in China for generations, centuries, has been family. But one of the implications of the one-child policy is the family structure isn't there anymore. China has 1 generation to get rich before it gets old. They have to make this transition to a first world economy, and first world developed economies don't grow at 10%. They actually don't grow at 6% either. They're lucky to grow at 3 or 4. I think that's the path that China's on. So yes, this is actually a diminishment of global economic demand. There's no question about that. But for a rather benign reason that a $13 trillion economy, the Chinese economy, is making that rare or even unprecedented transition. Europe's a different story. This is a graph of European GDP growth, and the most remarkable thing about this graph to me is you can look back, that goes back almost 20 years. My axis doesn't have to go above 2% to draw this graph. European economic growth has actually never exceeded 1.5% in 20 years. That's astonishing. And if you look at since the global financial crisis, which is rather obvious on all these charts, Europe has actually had another milder recession since then, and I think Europe's likely headed for another one this year. Part of that is secular, the lack of labor force growth, the lack of productivity, an overburdened regulatory state in the European Union. The Brits have got that part right. Part of this is also uncertainty as to what Brexit actually means. If you are a business on the continent of Europe doing any business at all with Britain, it's not altogether clear what's going to happen within a matter of weeks, what Brexit means. So that hit to sentiment is almost certainly dragging Europe back into recession this year. That says to me that the United States economy should not count on an acceleration in foreign demand to drive our own economy. It comes back, once again, all to the health of the American consumer, that domestic source of economic demand. So let me leave you with 2 parting observations. This is a lot of stuff to pack into 25 or 30 minutes or so. The challenge that we face as capital allocators, whether you're allocating capital in a financial portfolio, which is what I and my colleagues do, or you're allocating capital as a business owner, the challenge is always to make a distinction between those developments that threaten to impair sentiment, therefore price, and those developments that threaten to impair fundamentals, therefore value. It's just that easy. It's also just that hard. But where there is a difference between those two things, where there is something that impairs price or sentiment without impairing the long-term value, that's not a risk. That's an opportunity. If there's volatility in an industry segment that disrupts price, and as a business owner operator, you're able to take advantage of that, that's a benefit. As a portfolio manager, when you get into the 4th quarter of last year and stocks are selling off 3%, 5% a day without impairing the underlying value, that's an opportunity. That's not a risk. I think that's a challenge we all face in any economic environment, truth be known. But I think in 2019, with so many risks to sentiment, far more to sentiment than value, I think, these challenges are worth noting. I'm going to leave it there. I promised to show you my email address. If you can read it, there it is. It's just scott.clemons@bbh.com. I would be happy to send you copies of these slides. I'd be happy to address any questions that come up after we part company. But in the time we have left, which is about 10 minutes, I think, Siri, be happy to take any questions you have now. Thank you for inviting me to join you once again this year. Thank you. So I love this method of handing me questions because I can like make up questions. How could you be so smart and good-looking? Fabulous question. I won't do that. Your views on MMT, modern monetary theory. This is the theory. I'm sure you've read about this, but it's taken on new coin, if you will, in the new Congress, particularly among the Democratic Party. And she's not my congresswoman, but she's from New York, Alexandria Ocasio-Cortez, who says that the level of outstanding debt or deficits doesn't actually matter because we create the currency. We mint dollars, we can lend dollars, we can borrow dollars rather, and we can always afford, we shouldn't worry about debt and deficits and things like that. It's a bad idea. It's a bad idea. When you get back to your hotel room or your home tonight, just Google Venezuela, see how that works out. So here's why it's a bad idea, and this doesn't get enough coverage. It's inflationary. And it shifts the responsibility for controlling inflation from the central bank to the government. And if you really look into modern monetary theory, that's what it says. Because it says to the central bank, you don't need to worry about all the money. We'll print all the money. And you don't need to raise interest rates. Typically, central banks raise interest rates to constrain inflation. Modern monetary theory says the government will control inflation, not by raising interest rates, but by raising taxes. So if inflation gets out of hand, instead of raising interest rates, we raise taxes, and that stifles spending. Again, Google Venezuela. And by the way, I don't think this has a lot of currency even within the mainstream of the Democratic Party. And I don't mean this to be a partisan statement, but Speaker Pelosi did something really clever, although it was controversial, with some of these more outspoken and duly elected, intelligent, new Democratic representatives. She's put them on committees. That's unusual for a Democratic congressman. But Pelosi has said, you know what, these ideas you've got, come over here and sit on the Ways and Means Committee for 6 months and then tell me what you think. I think that's actually politically pretty smart to say, engage with the activity of government before you start throwing out ideas like that. Thank you for that question. Okay, but I'm around, and I'm looking for Siri to wave me down when time is done. When will the shift from growth stocks to value stocks happen? It's been 10 years of growth. It has been 10 years of growth. I think rising interest rates have something to do with that. And it's not been so much growth stocks leading the market. I think as everyone's aware, it's that Wall Street loves its acronyms, right? So it's the so-called FANG stocks. I think growth has been so scarce in an environment of rather modest economic activity that what does grow, Facebook, Amazon, Netflix, et cetera, gets so highly valued just because of a scarcity factor. It's a normal market development. Admittedly, it's gone a little bit longer than I would have expected. Let's see. Is 4% or even 3% economic growth rate a thing of the past for the United States? Sustainably, yes. I think yes. And here's the reason for that. I've talked about consumption being the primary driver of economic activity. And when you think about that equation for GDP growth, it's personal consumption, that's the big one. It's government consumption, government spending. It's business investment, business spending. And then the fourth and the smallest part of it is trade. Those four things. Those are four demand variables. Those all speak to various sources of demand, business, government, personal. If you look at the supply-driven model of what grows an economy, it's only two variables. In the long run, any economy anywhere in the world can only grow in line with two variables, the growth in its labor force and the productivity of that labor force. That's it, two variables. We're very fortunate in the United States that both of those variables are positive. Our labor force grows, our population grows, and it's a productive population. But when you add those two things together, they don't add up to 3 or 4%. They add up to 2 or 2.5%. And I think that's the long-run growth rate. Pause for a moment and think about how those variables play out in a market or an economy like Southern Europe. Shrinking populations, there's a negative sign in front of that variable. And Italy is not the first country that comes to mind when you think of productivity. Sorry, I mean, it's la dolce vita. I mean, it's good wine and food and song. I'm being flippant, but when those two variables are negative, as they are in a lot of Southern Europe, well, you saw the graph. It's very difficult to achieve escape velocity. What about risks created by overall debt levels? That's a good question. Corporate level, I think it says government and student debt as well. It's not so much the level of the debt that concerns me, it's the service on the debt. And so you look at that graph that I showed you of overall government debt at $22 trillion. That's a scary chart because we've added $10 trillion of debt just in the past 10 years. That's pretty remarkable. But the debt service, in other words, the interest rates that has to be paid on that debt, is actually at about a 20-year low. So debt levels are at all-time high, but interest rates remain relatively low, and the combination of those two things is why debt levels haven't been a problem. So the question is, when does it become a problem? It becomes a problem when interest rates revert to more normal levels. We can debate what that means, by the way, what more normal interest rate levels means. It's not sustainable. It's not sustainable. And I do worry about the fact that in the last fiscal year, a fiscal year in which the U.S. economy grew rather robustly, we ran a $1 trillion deficit. That should not be. Economically, that should not be. The reason it should not be is that what happens when the economy does go into the next recession? And you do want the ability to engage a little bit of fiscal stimulus in order to support economic activity. It's easy to see us running a $3 or $4 trillion deficit. That's unprecedented. At some point, that plays out, I think, in the form of higher inflation. It's not this year's concern, not next year, probably not the year after. This is a longer-term concern. But at some point, when you get debt levels that high, the way in which governments address those debt levels, well, you can default. Again, Google Venezuela, you can just refuse to pay your bills. I don't think that would ever be the policy of the United States. Or you can let inflation reduce the real outstanding obligation. Inflation is the debtor's best friend for that reason. And I don't think inflation would ever be the explicit policy of the United States government, but benign neglect can go a long way. Doesn't take much. 4%, 5% inflation, which we had 10 years ago. That's not, nobody gets a blue ribbon panel for that, is something that would actually pose a threat. to our clients managing portfolios, and I imagine to a number of you as well managing businesses. I'll answer one last question, and then again, I'm sorry if I didn't get to your question, but I'm around during coffee breaks, and I'll be around tonight as well, so by all means, buttonhole me. I don't promise to know the answer. I'm one of those rare economists that will simply say, I don't know the answer to that, but I'll try to find it if I can. How much are labor statistics impacted by people who are employed, who are not employed but not looking? That's a good question as well, because it gets to a definitional issue. If you are not looking for a job, you're not part of the labor force. So technically, statistically, you're not unemployed. To be unemployed, you have to be looking. So that graph that I showed you, I think it was colored red, the available supply of labor, only captures people who are looking for work. If you're sitting at home on your couch watching reruns of the Ellen DeGeneres show, you're not unemployed. You may be unemployable, but you're not unemployed. One of the things that we're beginning to see, though, as the unemployment rate creeps down and as wages continue to rise, there are more and more people who are getting off the couch and are saying, pardon the flippancy, maybe even a deadbeat like me can get a job. So we're seeing a re-entrance into the labor force of a lot of people who haven't been working in some cases for years. One more sign of how tight, how good the labor force is. And then anecdotally, and I'll leave it at this, I've said to you a lot of the companies, a lot of the people that we work with own and run businesses, and when I ask them what challenges they face, it differs obviously from industry to industry, but the one common thread is the inability to find qualified employees. You saw that at the macroeconomic level. We see it at the anecdotal level. I imagine a number of you see it as well. And so when I follow up and I ask some of our clients, so what are you doing about that? It's interesting. The tone of voice drops a little bit, and they say, well, you know, in the past, we've run really strict screening on misdemeanors and DUIs and drug use and things like that. And if we're hiring someone to drive a truck, if you've got a DUI in your past, you're not going to get that job. But if we're hiring someone to stock the warehouse, I think we're now willing to overlook that DUI. So there's a certain portion of the population that has been unemployable that is becoming employable again because of the tightness of the labor market. And I tie that back into my flow chart and think of what that means for more people with jobs and more money in their pockets. That's a pretty good tailwind. I'm going to leave it at that, and thank you once again for your time this morning. Happy to send you copies of these slides. Thank you.